Yes, good morning or good afternoon, wherever you might be. I'm Dr. Dan Westfall. I'm the president of American College of Medical Quality, and I wanted to just take a moment to welcome you to one of our bi-monthly seminars, webinars. Sometimes we do podcasts, but I wanted to welcome everyone to our newest presentation, which is by Ms. LeTian Dong, and her team with Tom Morris, and they're going to be talking to us about financial planning. I just would remind you before we get started that these bi-monthly webinars, CME activities, podcasts are all free, even to non-members, and I would encourage everyone to try to be involved and participate as much as possible. We've had some great presentations to date, and we will continue, so please remain aware of some of the presentations in the future by going on the ACMQ website, which will be updated. Without further ado, it's my pleasure to introduce both Tom Morris, LeTian Dong, and looking very much forward to your presentation. So thank you for joining us and being part of ACMQ.
Thank you, Dan. And
so first, let me do a little bit of an introduction here. So LeTian's been in financial services for a little over 8 years now. She's a certified financial planner. Last Thursday, so 1 week ago today, she was honored with an award from the American College of Financial Services as being one of the top 6 next generation financial planners across the country, across all companies. So I'm really proud to have her as part of my team. And I'll let you take it from there, LeTian.
thank you, Tom. And a little bit background about Tom. I have to say Tom's one of the most interesting people I know. Prior to being in the financial service industry, Tom had his hand in 14 different startups, primarily in the tech world. And I have to say both Tom and I have also connections to the medical world. Both of Tom's parents were physicians, and I'm actually married to one. And Tom started in the practice since 2005, so definitely have a lot of experience in the industry. So we have a presentation today for you that's originally geared for over an hour and likely bore you to tears, so we don't want to do that, and we'll move relatively quickly through the presentation. So if you have questions, please send them in the chat box or the Q&A box, and if we run out of time or don't get to your question or get to the level of details you wanted, please reach out. Our contact information is on the screen, and I'm also sure we can find a way to send out a follow-up handout sheet with our contact info as well.
So with both of my parents being physicians, one of the things that I have seen firsthand is that, a medical community has some unique financial challenges, as well as unique opportunities depending on whether you're running your own practice or working in a nonprofit hospital or a variety of things. And the with both my parents being physicians, my mom was a radiologist, a specialist, and my dad was in primary care. So, and so there's a lot of things that we go over in financial services, similar to building and flying your own plane. That is way past the amount of time that we have today. So we're really just going to focus on a few key things. So if you were on the runway with your plane, we're going to focus on, how much fuel do you have, what's your speed, what's the weight of the plane, the drag, and what kind of safety equipment do you have on board.
So translating that, we're only going to focus on 4 core areas of financial planning today. So these are a great place to start as you are a resident student or early in your career.
So the first one is budget. And that can seem like an intimidating word. But the reality is it's just a matter of how much money do you want to put into each one of the jars, right? Do you want to save it, or do you want to spend it? Spending is more complex sometimes, because part of it is that one of the things that you will end up spending the most amount of money on throughout your career is the taxes.
So we recommend starting with the 20-60-20 approach. And notice it doesn't say 20-60-20 plus another 20. So if you have income of 1,000, don't spend 1,200. Live below your means. So 20% of the income right off the top should be saved, and then 60% maximum on essential expenses. So that includes student loans and debt repayment. And the key is to reduce the 60%, because the more you can reduce that piece of the pie, the more you have left over for the 20% discretionary spending piece. And that's a lot more fun. So keep in mind what goes into the 60%. So if you're going to buy a bigger house, once you get into that, it's a long-term commitment and it's hard to get out of it. Buying that Mercedes, same thing. So people usually don't overspend on food, and if they do, it's a lot easier to make a lifestyle adjustment. So a good rule of thumb on these larger purchases is that if you can afford to buy two, then you can buy the first one.
So, so one of the biggest areas of drag for most physicians is student loans. You may be fortunate that you don't have any student loans. That's fantastic, but most of our clients do. And it often can feel like you're drowning and will never get above the water. So, like a plane that's dragging a big weight behind it, it's hard to take off. So you want to get rid of those loans and pay them off as quickly as you can, given other priorities and other certain unique features of your loans.
So let's do a real quick pop quiz. What do you think the median student loan debt is for medical education? I encourage you to pop the number. You think the answer, that's the answer, into the chat box. And we'll give you a few seconds to do that. I see answers coming in.
165 seems to be the front runner.
Yes. All right. And I see one for 200. If you said 200,000 either in the chat or in your mind, you are correct. And that is a lot of money. And that's not actually the high end of the scale either. I am guessing that at least some people in the room right now have more debt than that. So the prospect of paying that off, like Tom was saying, can feel overwhelming. But you do have options in terms of how you repay your student loans, and the key is to choose the repayment plan that best fit your personal needs. So here's a quick overview. Repayment plans can typically be broken down into two core categories: traditional and income driven. So traditional repayment plans look at how much debt is owed over the period of time it will be repaid, and you pay the same amount every month. With income-driven repayment plans, your monthly payment are calculated as a percentage of your discretionary income. So you pay less now and more later as your income increases. So another factor to consider is the possibility of public service loan forgiveness, which is sometimes possible with income-driven repayment plans. So what this means is if you work in public service and meet certain criteria, as you see on the screen, you may be eligible to have your loan balance forgiven. So meet criteria, and naturally there's paperwork involved. So also listed on the screen, there are additional resources that I encourage you to check out if this applies to you. Studentaid.gov has one of the most complete information available about all these loan options to help you make the right decisions. And also GradFin, they are experts, student loan consultants, so they can also help you make informed decisions on repayment options, loan forgiveness that's tailored to your own personal needs. And if you don't qualify for loan forgiveness or not using an income-driven repayment plan, you might consider refinancing your student loans. So there are pros and cons. Pros, you could likely get a better interest rate, which could give you some financial breathing room and save you money in the long run. Drawback is refinancing with a private company. That means you'll no longer have federal loans and the option advantages that come with federal loans. So for example, the pandemic relief policies, CARES Act, put most federal loans on administrative forbearance. So that paused monthly payments without incurring interest or penalties, but that would not apply to private loans. So again, resources at the bottom, Graphene, also a good source to go to for refinancing, as well as Splash Financial for refinancing options. All right, next section, protecting your income and lifestyle.
So sometimes your plan B determines the quality of your life. So be prepared, right? So the big areas that you should worry about early on, the first is disability insurance. So that's insurance that would basically replace your paycheck if something happened and you were sick or hurt and couldn't work. But the big thing is, if you can't afford to retire today, you need some disability coverage. If you can afford to retire and you're listening to this, great, give us a call. So the second is life insurance. If anyone is dependent on your income or your future income, then you should have some form of life insurance if you can qualify for it. This could be a spouse, it could be kids, it could in fact be your parents, for example, if they're responsible for your student loans, which I have seen in the past. The last is from a defense planning standpoint, is you want to have an emergency fund. Now, normally we say that an emergency fund should be between 6 to 12 months worth of expenses. If you've got lots of student debt, that one is not prudent, but it is prudent to have at least 1 month and then to build into a more robust emergency fund over time.
So on protecting your income, let's say average lifetime income is 200,000 and you work for 30 years. That's $6 million. All right, who got $6 million lying around, right? So really your future earnings, especially as a young professional, is your most valuable asset. And the 1 in 4 disabled statistics that you see on the screen, that's Social Security statistics. That's for general population. Unfortunately, medical professionals, the numbers are higher. So you probably have group insurance through your employer, which is usually relatively weak. So you want to pair that up with a fantastic individual policy. And you don't expect to pay $5 for great comprehensive coverage because insurance companies are on the hook for that $6 million. So you're protecting your most valuable asset. Don't go cheap. And not wishing for anyone to file a claim, but if you need it, you really will want the best policy that you can get. And expect to pay around 1 to 2% of your income for that. And another recommendation is work with a professional from one of the big mutual insurance companies. Mass Mutual, Guardian, Northwestern Mutual, they all make high quality products. And our last section, saving for retirement.
So retirement as a word, particularly for people who are young, often has it's way far in the future and has these negative connotations. But if you think about it more as financial independence, so that is being able to spend your time with the way you want, with whom you want, without regard to how much income it produces. So I have many clients, physicians who are continuing to work because they love what they do. It's impactful. They like it. Maybe they cut back a little bit, but they can do what they want. So if they want to take a 3-week vacation to Italy, they do it.
So as you can see, retirement is one of the top concerns for most medical professionals. And for anyone who doesn't have that 6 million yet. And one of the things that in working with our clients is just that we learned is to start early. Like Tom mentioned, you don't want to be the doctor working at 67 or 70 because they have to work and pretending like to like their job. You want to be on the other side. You want to have the option of working because you truly enjoy what you do, and not have to depend on it. Because we have had come across clients that we were helping. There was a psychiatrist client who was working at 80 years old, and we were finally able to help plan for them, and then they retired. But again, not the most ideal situation to be in. And by the way, life never turns out exactly the way you plan it. So definitely have wiggle room, right? And time right now is on your side. So start saving now. And there are different ways to save. The idea is you want to have a mix. The thing you will pay the most in your life is probably taxes. So you want to diversify the buckets that you're saving into. And also depending on your goal, saving them into short-term, mid-term, and long-term buckets. Again, the rule of thumb is to save 20%. So this should be a simultaneous funding goal as paying off student loans. You don't want to wait until student loans are paid off and then fund retirement. That's a little late. And on a 401k or 403b, most of you will have access to that through your employer. Take advantage of these employer-sponsored plans. Oftentimes, the employer match your contribution into the accounts, and that's like free money, so take it. All right, taxes. So you may have heard of your favorite uncle, Uncle Sam, the tax man, right? He always gets his cut, but he does try to give you some perks in tax qualified accounts. So on the left, traditional IRA. So how that works is you don't pay taxes going in. The value in the account grows tax deferred, and you pay taxes when you take the money out. Contributions to a traditional IRA may be tax deductible, depending on your income and whether you also participate in an employer-sponsored retirement plan. So as with the 401k, earnings in the traditional IRA grows tax deferred. So you can contribute up to $6,000 per year with additional catch-up contributions of $1,000 if you're over 50. On the right-hand side, Roth IRA. So that's the account where you pay taxes now, and it grows without tax, and you take it out and it's tax-free. So contributions made to a Roth are made after tax. So they will not reduce your taxable income today. However, your money grows tax deferred, and then qualified distributions from the Roth IRA are generally tax-free during retirement. So this may be a good option if you think you'll be in a higher tax bracket when you retire, or if you want tax diversification across your assets. The question that we often get is Roth a better idea? Usually it's yes, you're probably in the lowest income bracket now being a younger professional. So, and also if you think your tax rates are going down, encourage you to go to usdebtclock.org and see the growing amount of US debt, right? But the bottom line is you should have both types of accounts because no one have a crystal ball and know exactly what's going to happen in the future. All right, investments. So the stock market is a roller coaster. You probably heard the golden rule of thumb before: buy low, sell high, right? So you don't want to sell at the bottom of the market, and you don't want to put yourself in a panicky position. And really, the biggest risk to your retirement portfolio is you and your emotions, and also not having a professional that you can talk to, because when we think about it, your patients come to you for professional advice. Similarly, you should talk to a financial planning professional for planning and investment advice. All right, so we covered a lot today, and I know that was pretty fast to go through these 4 core areas of planning. So this should give you a great place to start in building your financial future.
And as we're wrapping up, one of the big things here is do you want to be the person who builds the plane and tries to be the pilot? Or would you rather just enjoy the ride? So thanks for your time today, and we'll open it up for questions.
Excellent. Thank you.
Yeah.
Thank you, Tom, and thank you, LeTian, for your presentation. For those of you who I haven't had the pleasure of meeting yet, my name is Amy Thomason, and I am the Executive Director of ACMQ. I want to thank you all again for attending the presentation today, and please send in your questions in the chat. I'm sure some of you have your own personalized questions, or if there are things you do not want to share with the group. LeTian and Tom, would you be open to having people email you one-on-one as well?
Absolutely.
Wonderful. So we can share that information post-presentation. But while people are sending in their own questions, I had a few that I jotted down myself, not necessarily just geared towards our student and resident audience, but today's Veterans Day. Are there particular, we see a lot of members of our ACMQ community who have served or are veterans. Are there particular challenges or opportunities medical professionals who are also veterans should be aware of or take advantage of that you would recommend?
LeTian, I'll let you answer that one.
Sure. In working with a lot of our veteran clients, one of the things we see is that there are some fantastic government benefits. So it's definitely taking time to understand what benefits that you have access to. And there's a lot of caveats, right? How long did you serve? And then a lot of circumstances. So again, it's to understand your situation, what's available to you. And again, creating a plan, a personalized plan with a financial professional with those things in mind.
LeTian, I just wanted to make a comment on you and Tom. Thank you for a great presentation. You know, as a veteran, you know, that I think people don't take advantage of is we're all finished with medical school and most of the training, but if not, if you go in and you haven't completed your training, you certainly are eligible for every month that you spend in a service. You're eligible to 1.5 months of educational benefits. And a lot of times those educational benefits don't get utilized. And I actually utilized them when I was doing my fellowship. And it really, well, my internship, my last year, and then 1 year of my fellowship. So, and then actually it was 2 years of my medical residency and 1 year of my fellowship. And that really made a big difference, you know, having that extra cash in terms of being able to have 3 moonlighting jobs versus 2. So, you know, but it makes a big difference. And there's a lot of advantages too. And I try to do this if a person can to try to stay in the reserves, because you only have to spend a small amount of time in the reserves each year, and you get, you know, all these different benefits. You get the PX, you get, you know, a lot of additional things in terms of discounts, plus you get a monthly stipend. So I tried to do that, but unfortunately the base where I was in an area of New York where I couldn't drive the 25 miles because most of the road was covered with snow in the winter. So I wasn't able to take advantage, but I just make those 2 suggestions as a veteran about what advantage it is to be a veteran, what you can do in terms of some of the financial opportunities. So I thought I'd just throw that in.
Thank you, Dan. Very insightful.
Yeah.
Sure.
Yeah, that's very good.
Wonderful.
My along those same lines, my dad entire med school experience, and then he had to serve a couple of years afterwards, was all paid for by the military because he was in the military. So he was a veteran as well. He did point out that he grew up on a farm and really knew how to use a rifle. And he said, when you're going through basic training, be sure to get at the end of the line because not everybody knows which end of the gun the bullets come out of, right? So.
Yeah, that's well said. That's true. You want to be way in the back of the line, actually behind a metal barrier, if possible. Yeah, they start waving the pool. We had it just as an aside. We had one of the physicians picked up a 45 and was waving it around, and it was loaded. So I tell you that the instructor, he wasn't very kind to this physician, but you know, I think he did the right thing. He really, I will tell you that doctor never did that again.
Yeah. Right.
We have
And
a few more questions that have come through.
okay.
One is, can you share your thoughts on 457B and would you recommend it?
That's a very specific question. The 457Bs that we run into, all of them are slightly different and they all have different restrictions. So again, that is getting a little bit deeper into why are you looking to fund it? What's your purpose? What's the long-term goal? And to do that in context of the overall plan, because some 457Bs have very finicky distribution rules. So you can put money in and that's great, but how you take it out is governed by those rules at different organizations. And it's also the back end that we want to take into consideration.
For those who are not familiar with what a 457B is, could you share a little bit about that?
Tom?
It is a similar to a, not every organization has it. They're nonprofit organizations. And you can defer taxes on money that you put in. And so it's similar to a 401k. They generally do not have any matches or any employer money going into them. Sometimes or oftentimes you can get money out prior to 59 and a half. So that's good if you're planning to retire early. But they often have requirements that you take money out much faster than a 401k in retirement. So, so for example, we run into them on a regular basis where you have to take all the money out of the 457 over the course of less than 10 years. So if you've put a massive amount of money into it, it really restricts at the beginning of retirement what you can do from a from managing your income. What I mean by that is, for example, a lot of what we do, let's say somebody retires at 65, you have till 72 to you have to take money out of your 401k. We'll often do a lot of Roth conversions during that period because taxes during those 7 years will usually be pretty low, right? But we may want to, instead of paying 40% in taxes later, pay 15% taxes now, as opposed to just paying zero. Right? So,
Thank you.
yeah.
I've got a couple additional questions. One I had myself and another one that was sent to me. The question I had is, we have a lot of both physicians, nurses, our membership is diverse. We have CMOs, hospital administrators, physicians, nurses, pharmacists, but what we see fairly frequently, actually surprisingly, in our community is that we see next generation. So we see families continuing along this track. So I'm sure for some of our members, they wish they could start over and think about this financial planning when they're pre-med students. But for those who have children who are coming through this track and are starting in pre-med or medical students, what advice do you have for them?
I'll take a first stab at that one. So a lot of it's going to depend on their personal situation, right? So it's you get a very different answer if you say, I've saved $100,000 for retirement, or I've saved 10 million, right? And so most people are going to be obviously between those two numbers. But if you've done well, what we find is that many people in the first generation underestimate their true financial capacity. Right? They don't know how long they're going to need the money, how long are we going to live. There's a whole series. So they have a tendency to be more stingy with it, if you will. So think about it this way. If I'm looking at retirement as one of the things that I'm trying to fund for myself to know, can I fund my daughter's med school, right? Then it'd be sort of like my wife, and I'm trying to figure out, how long am I going to be there in retirement? It's sort of like my wife saying, okay, go to Costco and pick up a cake, a birthday cake for your daughter. The kids, and I go, well, great, glad to do that. How many kids are coming over? Oh, somewhere between 10 and 35. Okay, that's not necessarily really helpful. So I'm going to buy a cake. The kids here, how many years are you going to be in retirement? So, so the question is, when the first kid comes to the table for a cake, do you give them a really big slice or you give them a really small slice? Give them a small slice, you have a lot of leftover cake if potentially. If you give them too big of a slice, you're going to run out of cake. So first thing I would advise is get a true assessment from someone about how much is your excess capacity. If you have excess capacity, then it's if you can help them out, that's a great thing to do, right? To make sure that they don't run into the debt throughout. We have clients who also let the student accumulate the debt, and then a few years after they're in practice, so they got all the way through, they're in practice, they'll actually pay off the debt or create some plan that they will pay off the debt for the second generation.
And then, Tom.
No, go ahead. I was going to say
Yeah,
that was
okay.
a really long-winded answer. Sorry. So,
And I was going to put in on, I guess, my own personal perspective is that, again, like in the presentation, is build the savings muscle early on. Because regardless, that's a good life skill to have, to track your monthly spending, track what's going in, what's coming out, and have the discipline to live below your means.
Wonderful. Thank you both. I had one question that was sent to me in chat as well. What are the benefits of finding a physician-friendly financial advisor, and how would one go about that?
LeTian, I'm going to totally let you take that one.
So the way I see it, it's personal preference. The joking way that I see it is I'm not a dollar bill. I don't expect everyone to like me, right? So again, it's I think investment philosophy, savings philosophy, planning philosophy, finding someone that you can connect with, because again, this being in an advisor role, I'm also in a coaching role. So this is someone that if I'm doing my job right, I will push you past the point of your comfort, because financial planning and getting to the point of financial independence quickly and under right the original timeline, so do better than expected, it's not going to be the most comfortable thing. So think of it as hiring a gym coach, right? It's not going to be fun doing those squats, right? You're gonna have to work for it. So again, so it's important to find someone that besides like we mentioned, being a certified financial professional, which the CFP designation gives a fiduciary level of care for the client, and that is that okay, at least that gives you a qualification standard. But besides the professional knowledge, I would really encourage meeting with someone, doing work with someone that you feel you can trust and you can connect with, because again, this advisor role is supposed to be someone that's going to coach you for the long term.
Thank you.
Yeah.
Tom, do you have?
Yeah, and I would add to that, the biggest thing is or one of the big things, other than that you get along with them, that they have some credentials. So you don't want to be working generally with somebody in the financial services industry who's within their first 3 years, right? Just like I really don't want to get treated for by a surgeon where this is the first one on their own, right? So similarly, there's that aspect. You do want credentials, but there are tons of credentials out there. So when you look at a credential such as the CFP, do more than just go to the website, dig a little bit. What did it really take to get that credential? So the CFP is a 3-year program. It's difficult to get. It's got a certain depth. There are other ones that some advisors can go to, and really by writing a check for $60, they get a credential. That's really not useful to you as a client, right? And I think that's the majority of it. So use somebody who's been around. Use somebody, as LeTian says, who can push you, but do it in a friendly enough way that you don't get too mad, right? But if they're not pushing you, then they're not doing their job. The last is make sure that they're, this word gets thrown around a lot, but is comprehensive. Right? It's easy to get trapped into thinking that someone who manages assets is a full-blown financial planner. And particularly when you're talking about debt and you're talking about other things that you can do, you really want somebody who will give you advice that is against their own self-interest, right? So look for that. So for example, you could ask somebody about college savings. And if their first thing is, the only way to do this is to put money with me, there are lots of ways to do college savings. That's one. It may be the right one, but it's not the only one.
Thank you. Well, I think that concludes all the questions that were sent in, unless anyone wanted to send anything in the next minute or so here. But I wanted to thank you both for joining us today. And did either of you or both of you have any parting thoughts? Now, if you could give our group, give ACMQ one piece of advice, our members one piece of advice, or one key takeaway, what would that be?
I would say that the number one advice that I gave my daughter that she said was the most valuable piece of advice financially that she ever got was that $0 times 1,000% return is still $0. So save money, right?
And adding on to that, it's a new piece of advice as I'm a millennial is, again, stick to the plan, because there's so many shiny objects, right? Oh, you have Bitcoin, you have all of these things that feels like it's like a shortcut in life. And sometimes a lot of times slow and steady wins the race. So so stick to the fundamentals, stick to the core, stick to the principles.
Thank you both for your time today. I think we just got some thank yous. I know our group really enjoyed the presentation today, and you had mentioned some resources. We'll be sure to follow up with the group and with our membership and just share those resources you had listed out in the presentation. And if any of you want to reach out to Tom or LeTian directly, we have their email addresses. Tom has shared his in the chat, and we have LeTian's as well. And they would be happy to answer some of your questions. So thank you for the generous offer of your time today and for putting together this presentation. If you have any feedback on today's presentation or suggestions for other webinars you'd like to see in the future, please email us at acmq@affinity-strategies.com. That's acmq@affinity-strategies.com, and we would love to hear from you. Thank you so much for attending today, and happy Veterans Day.
Thanks for having us, Amy.
Thank you.
You.